Morning and welcome everyone, and thank you for joining our exclusive webinar run jointly this morning by the International Forwarders and Custom Brokers Association of Australia Limited and HLB Mann Judd. My name is Kim Kellaway. I'm Head of Clients and Markets at HLB Mann Judd, and I will be your moderator. Our presenters today are Mariana von Luken, Partner Tax Consulting, Bill Nussbaum, Director Tax Consulting, and Jonathan Ackerman, who is a Director in Tax Consulting and also a GST Specialist. Our webinar today will cover JobKeeper 2.1, focus on the GST turnover and alternate tests, and outcomes of the federal budget. The presentation will go for approximately 40 minutes, at which time we will open up for questions. And I do encourage you to type your questions into the Q&A box in our Zoom control panel, and the presenters will answer those at the end of the presentation. I would also like to welcome Scott Carson, Commercial Manager, International Forwarders and Custom Brokers Association of Australia Limited. Over to you, Scott.
Thanks, Kim, and welcome registrants for today. IFCBAA has received a lot of requests over the past 2 months in relation to JobKeeper and to a lesser extent clarification on BAS requirements for reporting, particularly what constitutes at the G1 level of a BAS return, the definition of revenue for freight forwarders and customs brokers. So it's certainly been a challenge this is for the benefit of our HLB Mann Judd people that I've been talking to and corresponding with quite a bit over the last week or two. They're aware that members of IFCBAA have been certainly experiencing a number of occasions hardship in terms of drops in business revenue. And then there's also with the issue now of JobKeeper 2 after JobKeeper 1, some revised rules in terms of measurements. So today, I guess some of the key points that I might mention to members before I hand over to Kim and the Mann Judd presenters. Certainly we've spent quite a bit of time with the ATO JobKeeper division and representatives from HLB Mann Judd talking about 3 main issues to members at this point in time in relation to JobKeeper 2, qualifying for that status, and also BAS clarification of revenue. Those 3 items are, just briefly, the ongoing treatment of duty and GST disbursement cost charges to member customers as revenue, and also the principal versus agent ATO approved definition test. Also, there's some one-off factors. Some members have had peaks and troughs at different times during the JobKeeper measurement periods, circumstances beyond their control from an air freight and sea freight point of view. And also members are seeking clarification of how us as an industry, as forwarders, brokers, that applies to the basic and alternative tests if members feel the need to make those applications. So just to reassure registrants today, those areas have been talked about substantially to the ATO and HLB Mann Judd, and certainly a lot of work's gone into this webinar, and I certainly mentioned my appreciation from the outset for that. So without any further from me, Kim, I'll hand it back to you.
Thank you so much, Scott.
So that's what we're going to discuss. And we're going to leave about 15 minutes for questions and answers. So if I find that we're going over time, so it's 9:45, I'll just cut to the chase and go to the questions, because I think that's where a lot of people really want to answer their own questions and listen to us. If you go to the next slide, please. So just to, big picture, just to put you in the mood, JobKeeper, we call it version 1, is the one that just ended in September. So everyone on the call that was involved in JobKeeper version 1 would have got their money in October for it. So, you know, normal compliance. Now the question is, what happens? How do I get into JobKeeper 2? You have to the end of the month to do all the reporting and everything on your business portal or through your tax agent, depending how you like to do it. Now, JobKeeper version 2 starts 27th of September, but you have to the 31 October to enrol, and I'll explain what all that means. It's got a 3-month period where you get a certain amount of money and you have to reassess. And then if you want to continue into the next quarter, so January to March, you have to reassess again. And turnover is a big thing on that reassessment, which Bill's going to talk about in a bit more detail with Jonathan as well. And then you can get it again. And again, what changes in the October, November, December quarter versus the January, February, March quarter, if you meet the criteria, is that it just goes down the amounts that they pay. And I'll explain that. Next, please. Next, please. Okay, it's just I think it's just working slowly. Before that one, I think you just missed a slide. I'm not in control of my slides, which is, you know, for a person that loves control, it's pretty hard. Okay, so this just goes through the cycle of events. If you look on the right-hand side, you know, referring to the new JobKeeper, which is version 2.1. It's extended for 6 months, as I've mentioned, September to the end of March, but there'll be 2 testing times. Employers are required to reassess, and they reassess on actual turnover. And most employers would usually look at their BAS, and this is a problem with the freight forwarding. So they look at their actual for July, August, September, and versus in 2020 versus the July, August, September 2019. That sounds really easy, and it is for most taxpayers. From September, their new JobKeeper will step down. That means that the amount they pay, instead of $1,500, they'll be paying a different amount, and I'll go through that in a minute. It'll be split into 2 payments, and we'd notify, obviously, the ATO. It remains open for new recipients. If you weren't on JobKeeper previously, you may comply with all the criteria and be able to be eligible for the October, November, December period. If we go to next, please. So just a really simple version here, just to give you, and I'm going to say this in different ways, so then you're all on top of it. Is 30th of March to December, 1,500, it's gone. 28th September to 3rd of January, we've got the 1,200 tier 1 or 750. Now, how do you know which one do you pay? It's based on basically hours your employees have worked. So your full-time employees will be getting 1,200 a fortnight if you meet the turnover test. And anyone under 80 hours in 28 days is 750. And this is for the 3 months, October, November, December. And then if you look at January to March, you can see that the JobKeeper is going down in their rates. Next slide, please. So here it's based on the tiers, is the amount of money you get from the government is based on the 80 hours. And how do you know if someone's worked 80 hours? I mean, if they're full-time employees, from what point? So they look at usually if, you know, 1 March is the significant time when you're carrying on a business. So you look at the month before 1 March. So you go the month before and you go 28 days up to your last payment cycle the month before. And did the person work 80 hours or more? Most full-time employees will. So therefore, it's pretty much straightforward. It's 1,200. Now, if the person was employed on 1 July, you can use May as your starting point for the months. Now, that slide is wrong. Oh, no, it's right. If you go down, if you're under 80 hours in that 3rd column, you get 750. So usually that'll be your part-timers or casuals that haven't worked that 80 hours in that point in time. So you don't test it in July, August or September. You're testing it at 2 different distinct points. There is an alternative test if needed for whatever reason the person was on maternity leave or some sort of leave in February. Then the commissioner can deem a different period that is appropriate, being appropriate for what their work cycle would look like. Next, please. This is pretty much what we just said before, but if you want to just go back to the slide and remind yourself, eligible, I don't know if anyone on the call is eligible business participant. So normally what happens is if your employee getting salary and wages, that's where JobKeeper comes in. But if you're maybe a small freight forwarder and you're not getting a salary and wage, you may be paying yourself a dividend, that is the eligible business participant. I'm not going to really go through those rules in any great detail, but anyone who has any questions you can ask at the end on that particular point. Next, please. So here's just a little bit more information of looking at, the first one is just the different fortnights, because, you know, JobKeeper works on fortnights. So you understand what the fortnights they're talking about and when the ATO pays you. So if you look at the October period, that is a period we have 31 October to, you know, register, reassess, and also meet the wage condition. So what is a wage condition? The wage condition is basically understanding if you've paid the minimum amount. So if you're on JobKeeper and a person has been still stood down or for some reason being paid less than, say, $1,200 or $750 a fortnight, you can see there that that's what the monthly, the 2 fortnights look like. So that's the amount that you'd be paying a staff member for the month of, say, October. So someone on a casual under 80 hours will get $1,500 minimum. So you have to meet that condition of paying that minimum amount. So if they would normally get $1,200, you'd have to top it up by 3. But I think you're all aware of that because it's the same as the rules that JobKeeper 1. And it goes on from November. It just talks about when the ATO will pay you. It'll pay you in the first weeks of December. Same as JobKeeper 1. If we go to next, please. So no change to some of the rules. So meaning of eligible employee, what is an eligible employee? The only change is obviously what already happened, which was if an employee started before or 1 July or before, they can now become eligible employees. You need to meet the wage condition. That hasn't changed. Your specified percentage. So before, you know, you're identifying if you're not-for-profit, you're 15%. Most of you are not not-for-profits, I think, unless maybe the association itself. But most of you will be in the 30% or 50%. Usually the 50% is if you're globally owned and your aggregated turnover globally is over $1 billion. So you know that if you are. Most of you will be sitting in that 30%. There are special rules for service entities where, you know, you may have a few different entities, probably not as much likely in the freight forwarding. Is that right, Bill? Do they
Yes,
use
that's correct. That's right.
Yeah. Okay. So don't worry about the next bit because you're not charities. Enrolment process, there is the normal enrolment process, which we can go through. Timing and monthly payments are in arrears, the same as before. Monthly reporting, you still have to report monthly, like, you know, the actual amount and what the projected is. That'll be just done through the business portal or through your tax agent. They can use the tax agent portal. Monthly reporting of turnover, which we talked about. Rules preventing more than one employee claiming the same. So basically, if you have employees that are with you full time, that's fine. But if you have employees that are with you casual and they're full time somewhere else, usually they're not entitled to the JobKeeper because their full time employer would be entitled to it. And then the tax treatment of JobKeeper, it's assessable. That hasn't changed. You don't include the JobKeeper payments in your calculations, but it's still calculated as assessable for income tax purposes. Next, please. We're coming to bills soon, so you're getting all excited here, I can see. Well, I can't see anything really. So what is the GST turnover? This is probably the crux of your question. So I'm just going to talk about it basically and then switch over to Bill. So the current GST turnover is the amount of your sales except for the following. So normally you would look at your business activity statements, quarter, normal business, and you would take out the GST portion. Sales that are input taxed. So if you're a financial services, this is more for the financial services industry, they're probably not in JobKeeper because they do a lot of share trading, bank interest, like your banks, and residential rents and so on, and commercial rent. So that's out, okay? So residential is rent, not commercial. And that's input tax, meaning there's no tax on those, GST. And I've got my expert over here, so he can correct me when I'm wrong. Sales not connected with enterprise that you carry on, private sale of car, so on. That's okay, that's pretty logical. Sales not made for payment. So if they're not basically taxable supplies, payments where there's no supply. Gifts and donations, again, this is more for not-for-profits, so I wouldn't be worried about that because not-for-profits don't normally include GST, gifts and donations in their business activity statement, but it is a requirement to include it in their calculations. You don't have to worry about that. Now, sales not connected in Australia, this is a bit of an unusual one, but basically your export sales are included, okay? I don't know, Jonathan, if you want to talk about this one a little bit more, sales not connected with Australia, and examples of these ones. I mean, my understanding is if you're a business that maybe you're helping, you know, Thailand sell to France, the goods never really come through to Australia, that's the kind of sales that are excluded. They don't even go in your BAS. But in most cases, if you're making sales overseas, then that's included. It's not excluded, as in this case. I'm just going to hand over to Bill, and if we can go to the next slide.
Sorry, Jonathan, did you want to make a point there?
Yeah, I was just going to say that the Connected with Australia test is a technical test. So, and a lot of these rules around, you know, what's included and excluded in turnover, you know, has a very technical meaning. So it can be quite complex to work that out. In terms of that last sort of point there around whether, you know, effectively supplies that are not connected with Australia are excluded from turnover. So, you know, an example of that would be a company that has, you know, operations in Australia, for example, and the US. So it might have a branch in the US. So it's revenue from its US operations generally wouldn't be included in its JobKeeper calculations, but, you know, it's revenue from its Australian generally would.
Bill, before you commence your presentation, I'd like to launch the first of our polling questions, if I may. And our first polling question is, are you having issues determining what is included in G1 revenue? I'll now just end that polling and I'll share the results with everyone. So at this point, 33% said yes, 45% said no, and 21% were unsure. Over to you, Bill.
Okay, thanks, Kim. So, as Scott has mentioned previously, so there are quite a number of issues which members are facing. And as you would all know, that many members have had their business volumes reduced, their margins have been squeezed, and costs have generally increased. Increased costs could include the introduction of the congestion charges, the massive increase in air freight rates, and also other costs. So I suppose the particular concern is the impact of these increased costs on members' GST turnover and hence eligibility for the JobKeeper. Just want to talk firstly about gross margins. What I mean by gross margins is like net revenue. So back in April this year, when JobKeeper 1 came out, we wrote to the ATO because a number of members had had voiced their opinion in terms of increased revenues, and we asked the ATO whether members could use like disclose G1 as on a net revenue basis or use their gross margins, so gross revenue less costs. Unfortunately, the ATO response wasn't very helpful and really didn't clarify their position on this. The other point was the GST free sales. I think that's also there's been a little bit of initial confusion surrounding what the definition of GST turnover is, and Mariana mentioned that in the previous slide. But the ATO and the association did write to the ATO, and the ATO basically has confirmed that the GST free sales are to be included in G1. Then the other issue is the treatment of disbursements, and as you would all know, many members would incur various costs, on behalf of clients. such as duty, GST, import processing charges, port and terminal charges, for example. Yeah, the question really is for members is whether these costs separately charged to clients are included in the members' GST revenue. And it really depends, and it seems to all depend on this. It comes down to whether the member is incurring these costs as an agent for a client, i.e. just a client disbursement, or as a principal where it's in the member's own right and not on behalf of a client. So where a member agent acts as an agent for a client and the costs are on charge to a client, these can be excluded from the GST revenue. Where a member, of course, acts in his own right as a principal, these on charges should be included in the member's GST revenue. Again, with the association, we have engaged with the ATO on this and to seek further guidance. And the ATO has basically confirmed that amounts that are imposed by statute, for example, GST and customs duties and some import processing charges, are paid by members as agents of clients and therefore can be excluded from the members' GST turnover for JobKeeper purposes. So Jonathan, you want to maybe just expand on the ATO engagement that we had and some of their comments regarding these costs, especially the other costs, and what they said.
Sure. Thanks, Bill. So yes, Bill sort of touched on a lot of these issues. So the main sort of issue I think for a lot of members is when these disbursements, when these costs are on charged to their clients, is that included in JobKeeper turnover for effectively their GST turnover? And Bill mentioned the various costs that we're talking about. And for most members, if those costs are included, it's probably likely that they're going to fail the JobKeeper turnover test, the decline in turnover test. So yeah, we've been through it, as Bill mentioned, a process with the tax office. Probably just a couple of preliminary comments to make. While we're talking about JobKeeper here, that issue isn't a new issue, and it's been around for a long time, and it is relevant to a number of other tax issues. So, for example, it was relevant to the cash boost eligibility for members, even in terms of income tax and GST reporting, eligibility for small business CGT concessions for members, TPAR reporting. So it's not unique to JobKeeper. It does arise in a lot of different tax areas. And it is important as well that members take a consistent approach to that issue across various taxes and tax concessions. Probably the other issue to mention, and it's probably quite important, is that a lot of the accounting systems that are used by members take a particular approach to the issue. So they'll just make an assumption. And often from our experience, they assume that those costs are included in turnover and therefore automatically include those costs in G1 for BAS reporting purposes. Now that may not be correct, and it's really necessary to have a look at each of those individual costs and work out whether that approach that the accounting system is using is correct, or in fact, whether they should be excluded from turnover and therefore excluded from the JobKeeper test. So with those sort of preliminary comments, I guess we engaged with the tax office, around this issue of how to treat disbursements, as Bill mentioned. And as Bill indicated, tax office did make a positive comment, which was that statutory charges such as GST and duty are excluded from JobKeeper turnover. So that was a good concession that they made. I guess, unfortunately, the ATO wasn't prepared to provide more definitive guidance in relation to other costs. So effectively, the tax office's view was that they didn't have any discretion to apply the laws in a more concessionary way for members, that effectively they just pointed us to guidance that they'd provided in GST rulings on, that concept of whether a taxpayer acts as agent or principal, and really didn't give any more guidance than that. So unfortunately, it's really a matter of taxpayers and members working out for themselves, how to treat these costs. And I suppose a couple of things, the best evidence as to whether members are acting as agent, so on behalf of clients or on their own right in incurring these costs, will be agreements with clients and what the agreements say about how they're acting. We actually expect that that's probably not all that useful, that most agreements are probably silent on that issue. So then really looking at the tax office guidance material, it becomes a much more vague sort of process that you really then need to go through and look at all the factors. And it could be that some costs are included and some costs aren't. So unfortunately, there's no sort of simple answer. And effectively, the tax office sort of pushed it back on members. So I'll hand back to Bill to sort of to carry on.
Yes, just a quick point there. Obviously, if you do take out duty, well, you are allowed to take out duty and GST in your turnover, calculating turnover, but obviously you need to take if you're comparing it to a previous quarter, you obviously need to take it also out of the previous quarter that you're comparing it to as well. It's got to be like for like. Now, Mariana, do you want to, next slide, Kim?
Unmute myself. Thank you. Yes, thanks for that, guys. Now, it can be the case that you don't meet the basic test. And as we discussed before, the basic test was that July, August, September quarter 2020 versus July, August, September quarter 2019. What happens if you don't meet it? And you don't meet it because, yes, you've excluded all the things that Bill and Jonathan have talked about, but it just isn't working for you because maybe you've had an increase in income. Maybe you've commenced business after those test periods. Maybe you've had a restructure. Maybe you've restructured your business. So maybe you've had irregular income. Maybe you've had growth. So I think there's two tests there that unless you specifically commenced your business later or restructured, that I'm going to let Bill talk about. Back to you, Bill.
Okay. Next.
Bill, what we might do is we have that other poll question, so I'm going to actually launch that question now. And the question is, do you need assistance applying the alternative test or 80-hour work test in the relevant period?
We can't vote, Kim.
No.
Yes.
What are we going to say?
Your votes at the end, Bill, when we ask them how good you did.
It's a worry if we did and we ticked a certain box.
Yeah.
All right, I'll end that poll there now. And in terms of those results, we had 13% said yes and 87% said no.
Okay.
Thank you for that. Over to you, Bill.
Okay, so just to reiterate, this is quite important. There's obviously the basic test, which Marianne has talked about, and that's sort of comparing the September quarter turnover to the previous September 19 quarter. But as we discussed, it may be, because of the significant increase in costs, it may be difficult to pass this basic test. So there are quite a few alternate tests which Mariana put on the screen before. However, I think the two most relevant ones for members is probably the substantial increase in turnover test and the irregular turnover test. Both tests are very complicated. If you think Einstein's theory was hard, well, this is on the same level, I think. But what I thought I'd do is maybe I'll just concentrate on the substantial increase in turnover test, maybe to give you an idea of what's involved. So next. So in terms of this test, it's an interesting test because what it lets you do at a high level, it lets you test if you are eligible. It allows the company to use a different comparison quarter to September 2020. So normally under the basic test, you're comparing September 19 quarter to September 2020. This one, if you can come into this one, for example, you could, for example, compare the December 19 to February 2020 period to the September 20 quarter for a decline in turnover. So it gives you a different option here, depending on the circumstances. And there's two stages for the test and two steps. And firstly, but in general, you know, where there's been a substantial increase in GST turnover, there are various tests here, you know, where, for example, you've had an increase of 50% or more in your turnover over a 12-month period, or you've had a 25% or more increase in turnover in a 6-month period, or a 12.5% increase in turnover over a 3-month period. Look, rather than try and get the nitty-gritty, I thought I'd just give a simple example so everyone can follow this. So let's say we have an example here. So I've gone for the 12.5% test because that seems to be the easiest test to pass. So if the member has had, say, revenue in the month of November 19 of $50,000, and you compare that to the revenue of the member in 2020 for that month, say of $60,000. So it has increased by more than 12.5%. So you're only looking at it, comparing it to 3 months. So if it's increased by more than 12.5%, that means you've satisfied the first step. The second step is then you compare, you have to compare the quarter February, the February quarter, which would include December, January and February. In my example, you say 180,000, and you compare that to the September 2020 quarter of $100,000. So you can see with those numbers, the revenue has declined by 44%. Therefore, you've basically passed that test. You've gone over the 30% decline and threshold. So it's letting you test a different period, which may help, you know, some people. So I think the main issue here is I think it is worth actually doing this test just to see if you do satisfy. Obviously, if you fail the basic test, it's probably worth having a look at this test and doing the numbers and see if you can pass this test. Okay, back to Mariana.
Yeah, thank you. Next slide, please. Yeah, thanks, Bill. Yeah, I think you can test yourself for all 7 tests or 8 tests. You only need to meet one of them, the alternative tests, to be in, if you're thinking about it. So conditions for eligible employees. How are we going for time? I just want to make sure we get to the questions. Yeah, we've got enough time. So 9:45, we said we'd jump onto questions and answers. So I'm going to speed through this. We've already talked about this. Individuals for the fortnight, you look at the fortnight and are you meeting the wage condition? And, you know, there's a lot of concessions around that, especially 31 October, making sure that, you know, you pay the top up. Employer qualifies JobKeeper in the fortnight. Remember, the employer still has to qualify you carrying on a business from 1 March. You know, you satisfy the decline in turnover at the beginning of the fortnight. All those conditions we had for JobKeeper 1 are still there. Entity is not excluded. Okay. You're not any one of those, major banks, government entity, etc. in liquidation. Next slide. Eligible, an entity is entitled JobKeeper for eligible for a fortnight if individual's eligible employee. So again, you know, what is an eligible employee? Same as before, you know, Australian resident, not a lot of the visa holders, maybe some New Zealanders, and it goes on. And also, just thinking about it, it's, you know, 1 July, before 1 July. People have asked me what happens if I get rid of someone and they start today. Too bad. No, they're out. So it's 1 July and before, nothing after that. So anyone new? I mean, if someone was on maternity leave, they're employees, and they're employees since 1 July or 1 March, they're in, no problem. And you can start paying them if you're eligible. Employer satisfies the wage condition. We've talked about that. The employer must pay every eligible employee a minimum amount. That's the minimum amount we talked about. Either they're in tier 1 or tier 2, 1,200 or 750 for that October to December period. Employers must notify the commissioner of their participation. So you need to enrol. Well, we've already enrolled in JobKeeper version 1. So you don't need to send out nominations again. You don't need to do much more than go into the business portal. And there is a specific section about the reassessment. Now, the ATO will assess it automatically through your BASs. But say you're using an alternative test, you need to go in there and change the figures. Or say, for example, you're excluding certain things like the GST and the customs duty that Bill and Jonathan were talking about, you may need to go in there and change the numbers. So make sure you do that. Otherwise, they can deem you ineligible and you haven't even done anything. Next slide. Entity is entitled to JobKeeper for an individual if the employer notifies the commissioner of the required information per fortnight. Again, this is done through your STP. Also, in the initial enrolment, you have to notify the commissioner if your employees, each individual employee, whether they're in tier 1 or tier 2. Now, you don't have to do, it doesn't change every month. It is going to be exactly the same. So you need to look at, as I said, before 1 March or before 1 July, whichever works. And then 28 days before that, are they 80 days or not? If they're 80 days, then they're in tier 1 for October, November, December. And then we have to retest again for January, February, March. Also, the employer needs to notify the commissioner if they don't wish to participate, or if an employee resigns and leaves, same as before. And there's integrity measures so that, you know, if people are fudging the figures to get into the rules, well, there'll be an audit at some point, and they're probably going to investigate some. They're not everyone, but if you are unlucky enough and you've done something wrong, well, there'll be probably some rap on the hand. Next, please. So relevant for employees is the 1 in all in, that rule still applies. So it's really about the employee. You have to offer it to all your employees if you're eligible, unless they don't meet the criteria. You know, they're non-residents or they're under the age or whatever it is. But the employee, if they say no, they don't want to participate or they can't participate, that's okay. That doesn't mean they all still have to come in. And nomination notices given to the relevant, okay, we've done all the nominations. Anyone that started before 1 July is already done. Relevant employees, we've talked about that. The main thing to consider is if you're long-term or casual and you started on 1 July or before 1 July, you have to go 12 months back and say, you know, is the casual regular and systematic for 12 months? Same test as the 1 March, just for the other employees. Who's a relevant employee? I've gone through that. So next slide, please. Next slide. I think they might have problems with that. Okay, here you go. I think we've all talked about this one. Next one. I think it's just having a little system error issue. So this is just a little summary for you. I've just done it in different ways. I've already mentioned it before, but the last row there is the periods, and you know the dates. The yellow line is about where your BAS lodgement's due. So you know it sort of all systematically happens together. Next slide, please. Again, I think I've talked about these ones, so we can just go down. We've talked about that we need to reassess. If you're already in JobKeeper, we're using actual GST, no longer on projected. You know, the 1,200 a fortnight, 750 a fortnight for that October, December. Next slide. Fourth to January to March, we've talked about that we'll need to reassess again, and that'll be in January period. And you'll probably get the extended period to have time to reassess. in that period, the payments will go down, and you'll probably have to notify the tax office again what your employees are receiving for those 3 months, 1,000 or 650. And the last bit is on the business participant. Don't worry about that. Next, please. I sort of want to get to the questions. I just want to quickly run through the budget. Next slide, please. I think Kim might be having problems. She's not asleep, I promise. The one before. Technical, love it. Okay, so the federal budget, I'm just going to run through this in a minute. There's a lot more there. Obviously, if you want something tailored advice to yourselves, come and talk to us. Come and talk to Bill, myself, or Jonathan. So just some highlights out of the budget. We're all probably sick of it. You probably know it inside out. But I think the biggest thing that happened from budget night is that those that do have money can, write off those expenditures. So if you've got a turnover of 5 billion, so globally, so that's pretty much everyone in Australia, you can basically write off your expenses, any plant and equipment bought. So that's a really good incentive. Obviously, you've got to have the money. So it's only useful until that time. So 30th of June 2022 is the cutoff. Another thing to be aware of is the company tax rate. If you're carrying on business, obviously, and you're not earning all passive income, is that the tax rate for this financial year, 30th of June, some of you may be December year ends if you're foreign owned, but 30th of June 2020 is 26%. And then next financial year, 2022, is 25%. So keep that in mind. The tax rate is going down for corporates. The one that I'm going to leave that last one for the last slide, the loss carryback. I'll talk to that slide in a minute. The superannuation guarantee, there wasn't anything on that really. It was just the fact that it is increasing to 10%, and there hasn't been any notification that there's a change to that from 1 July 2021. And that was always on the cards. We thought that they might stop it or reduce it or something, but not at the moment. Personal tax cuts, so most of your employees from 1 July should be getting more like 2,000 in the hand over the next year, so because of the tax cuts, so the threshold changes. And there's also a few concessions. So for those businesses that there's a few concessions for businesses with turnover under 10 million, but with the freight forwarding, you can reach that figure pretty quickly. So they've moved that to 50 million. Some of those concessions might be like fringe benefit car parking. So for businesses with turnover under 50 million, they're exempt. You don't have to worry about it, things like that. R&D, not sure much of freight forwarding is doing R&D, but if you are doing it, they're keeping the rules pretty similar. And 1 July, for up to 1 July, then from 1 July 2021, they're going to change slightly the incentive, but it's all good. We're still staying on 43.5 if you're under 20 million turnover, and that is aggregated turnover. And if it's over, then there is a bit of a tier system as in the rates, but it's much, much better than they were proposing previously. Next slide. So the last thing I just want to cover off so we can go to your questions is the carryback of losses. So I just put a little timeline there so it's easier to explain. I didn't put any numbers in there, we're having some issues. But what the carryback losses do is that in 30th of June 2019, say you had a profit. Now most of the freight forwarding business I don't think are going to go into losses in 2020, but who knows, right? But they're saying here that if you have a loss in 2020, you can carry back that loss and offset it against your gain in 2019. So you can get your money back on tax paid that you paid in 2019. When can you get your money back? It's interesting that it says that you're going to have to get it back when you do your 30th of June 2021 tax return. So it's a long wait to get your money back. That's all I can say. But say, for example, you make a loss in the 30th of June 2022 year. That's the cutoff date. This is only applying for a small period of time. You can go back, and if you made profits in 2020 or 2021, you can go back and offset as well. So it's only that period that they're looking at, 30th of June 2019 to 30th of June 2022, sorry. And just to keep that in mind, it's a good concession should you make a loss, but that may not be the case with the freight forwarding. We should go to questions now.
So I'll just ask the first question. Is it common practice in the customs broking industry to pay the duty and GST on imported goods to ABF. We settle the owner's account after receiving payment of a disbursement, no income or profit component included. Is this included in G1 or G5 on our BAS return?
Yeah, maybe I'll have. Maybe I think this probably goes to the heart of what we were saying previously. I think you can exclude the duty and the GST from your G1 in your BAS return. Not sure we say G5. I'm not sure there is a G5. Maybe you're thinking of G3, which is a GST-free sales probably. Normally, if you made GST-free sales, obviously they would go in. But what we're arguing, or what the ATO have confirmed that you can exclude that from your G1 and G3 in the BAS. But you need to be careful because, as we've mentioned before, I'm not sure if you're using CargoWise, but I know CargoWise directly takes all those types of costs and puts them into G1. So you'd have to then, when you're doing your BAS or you'd have to manually adjust for it, reducing that G1 figure. So that would cover both duty and GST. Jonathan, is that how you would look at that?
Yeah, absolutely. I think that's absolutely correct. So, that's one of the few things that the tax office actually definitively confirmed, that those sorts of statutory charges such as GST and duty are specifically excluded from your G1 calculation. As Bill mentioned, some accounting systems such as CargoWise will automatically include them in G1, and it's possible you may have just reported them in G1. That's not correct. And certainly when you're doing your JobKeeper turnover calculations, you can exclude it. You'd also then expect that if you've included it in G1 and reported it, but it excluded it for your own JobKeeper calculations, that you're going to get a query or review from the tax office.
How practical is it to exclude it? How easy would it be to exclude it? I imagine, you've got thousands of these entries going through. That's probably the bigger question, isn't it?
It can be excluded, Mariana, because most of these systems, and there's a small number of software systems that our members are using, it effectively would be just reconciling that by charge code. So taking what way the system's spitting it out, and then retaining that data, and I guess having that evidence of that data, not just want a better description, taking a punt on those figures, because if you are audited, correct me if I'm wrong, you're really going to have to show a detailed reconciliation which is verified by data. The other point I'd mention too, and it harks back to what Bill mentioned earlier on in the presentation, is that I guess there's two things here. There's a number of members may very well be now, as a result of this this presentation, revisiting how they calculate and report their G1 revenue. That may very well be lower now because they're taking out particularly duty and GST. So that's one thing. The second thing is, if they are claiming then for JobKeeper 2, is that, as Bill mentioned, it needs to be a like-for-like comparison on any revenue drop. So if you start now taking out duty and GST and you previously didn't, that would, I would assume, the ATO would take a view that that's artificially reducing the income. So you'd need to then, in the comparative test, show that your comparison was, and possibly go back and change that in your BAS to reduce that revenue figure as the comparison period, if that makes sense.
Okay, I might just take us to our next question. International freight is GST exempt, although GST is paid on this as part of the settlement on the import declaration. How should we handle that?
Well, yeah, I think that forms part of the, it's sort of the same as the previous think it's part of this previous question. This is talking about GST. I assume, Scott, they're talking about GST on the paid for on the importation of the goods.
Yes, at that point,
Yeah.
yes.
Yeah. So this is the client cost.
Yep.
This is the client cost. Yeah. So again, this would be GST that the client's GST. So, and sometimes the custom broker may be paying that on behalf of a client to clear the goods. Is that right, Scott? That would, yeah. Yeah.
Yep, that's correct.
Yeah. So again, that would be the same principle as the duty. It's not your revenue. It's just really a disbursement that you're making, and there's no markup or anything on it. So again, that would be excluded. A bit similar to what we were talking about before with duty. Same principle.
Okay, thank you. If a business has undertaken an acquisition during the assessment period, which has resulted in an increased client base, therefore increased GST revenue, does the ATO factor in that in the reporting in this case is not a true assessment of how the business's GST turnover is tracking? And is it possible to gain a specially convened assessment in this case?
So maybe I can answer that one. So if you can't meet the basic test, and you won't be able to, probably because you're increasing income, you go to the alternative test. So this is just a matter of talking with your advisor, which alternative test suits you. It sounds to me like the increase of income would be the test that you look at. And if there's been an increase in income, and I think Bill sort of specified that a little bit, it tests 12 months, 6 months or 3 months, prior to sort of September or different other periods. And if you've had an increase of certain percentages, 50, 25 or 12, then you effectively look on to the next part of the test to see if there was that turnover decrease. So it does modify it. Now you can't go and ask for a commissioner's discretion because the commissioner's already given it to us through the alternative test. You just have to apply that test to your business. And it may, the increase in income may not be the right test as well. So you just have to look at the circumstances. Sorry, Scott.
Thanks, Marianne. Yeah, look, I'm guessing, just reading between the lines on that member question, that I guess I'm thinking through my mind, and if the business, say, would have normally had, say, 5 million in GST, in G1 reportable revenue for the year, then within a certain quarter, BAS reporting quarter, they acquired a business that had $1 million in turnover, that would, in that member's question eyes, that would then uplift it to $6 million, but it would have normally been 5 million had that acquisition not taken place. So the $1 million difference is the client revenue that came across from the acquired business. So if I understand that right, it's a matter of then moving into that alternative test and building that argument with data to legitimately apply for a concession in that regard.
That's right. I mean, there's formulas in there to take into account that increase in income. So you may have just started 2 years ago and you're steadily increasing substantially. That's what those tests are there for. So it's not so easy to explain. It's easier to just get the data and put it into the format that we have, and then it spits out whether you're in or out. If life was so easy. But yes, exactly what you're saying, Scott.
Thank you. We've got 3 questions in a couple of minutes, so I'll just quickly go through these. It's been said that if we act as an agent, pass-through charges do not need to be included, which only leaves our handling and clearance charges to be included for JobKeeper.
Well, yeah, so I think it comes down to these. I think the ATO is only considered on the statutory charges, duty, GST, other charges a little bit more in the grey area. Obviously, the normal custom broking or freight charges, they have to go in, but yeah, I think that's a little bit in the grey area. Jonathan, for the other costs.
Yeah, I mean, I think that the tax officer confirmed that if you're acting as agent, you exclude those uncharged costs from your JobKeeper calculations. But in a sense, that sort of begs the question. So, talked about before, whether you act as agent or principal is quite a complex issue. So it's once you get to that conclusion that you are acting as agent in relation to particular costs, then that's pretty clear. But getting to that point can be quite complicated.
Thank you.
I think if I can just briefly, I'm again trying to read between lines with that member question. They're probably thinking the substantial part, depending on the shipping terms that they're contracting with their customer with, is the freight component, the international freight component, whether it be air freight or sea freight. So, if the ATO, correct me if I'm wrong, it deems that the contract is actually issued by the contractor service, is issued by or controlled by the member, then that international freight component to the airline shipping loan CTO operator would be need to be included. So I think the clarity needs to become by default, where can you legitimately exclude the international freight component? Because otherwise by default it must be included, is the way I understand it.
I think that's right, Scott. Ultimately, you need to do the analysis and work out, how those costs should be treated. But if they're included in, if they're not sort of separately on charged and just form part of, the members' sort of markup, then generally they would be included in turnover. If they're recharged as a separate cost to the client, then that's where you get into questions as to whether the member's acting as agent or principal.
So would you say that it's correct that the ATO has not given consideration to the pandemic impacted higher turnover due to air freight rates being 4 times the usual rate?
Yeah, we did approach as I mentioned before, we did approach the ATO under JobKeeper 1, and we specifically asked this question about gross turnover increasing because of these issues with air freight costs going up significantly, and we were trying to argue for the ATO to use a net revenue basis for freight forwarders and custom brokers, but really they just didn't really give us much information, and really just went back to the old chestnut as Jonathan was talking about having to look at the contract and is an agent principal. So yeah, unfortunately they didn't let us, they won't let you use on a net revenue basis. Yeah, unfortunately.
Okay. We have actually come to our time now. I'd like to thank our presenters, to Mariana, Bill and Jonathan, and thank you, Scott, for the opportunity to be able to present to the members of the International Forwarders and Custom Brokers Association of Australia Limited. I have a polling question that our last polling question, which I would like to just put up now. If you would like someone from HLB Mann Judd to contact you to discuss your business or anything that you've heard on this webinar today, please complete that poll. So I'll leave that there. A recording of this session and the PowerPoint slides will be made available to all the participants and for others within the association. Did anyone want to say anything in summation from our speakers, Bill or Mariana, before we say goodbye to everyone?
Just one thing, I think that to keep in mind that if you have specific circumstances, and it may be a little bit late now because we are on the 22nd of October, but if this issue was sort of prevalent in JobKeeper 1, that if somebody comes forward and wants to do a complex resolution with the ATO, we're happy to put it forward. We just won't do it for nothing, I guess, we're not a charity yet. But we're happy to do that for clients. And that means it's a no-name basis, but we ask the question. Now, as I mentioned, and that's with any tax issue that arises, But as I mentioned, it may be just a little bit late now because you're 22nd of October. But if you think you're heading, you don't meet it for this quarter and you want to meet it for January, February, March, and you think by having those fees taken out, maybe that's an alternative or a solution. Something to consider. Bill, do you have anything to say?
Well, I think, I mean, yes, you can do that, but I think what the ATO has been saying to us is you would have, the custom broker or freight forwarder would have to provide the various contracts as well to the ATO for them to review for this principal agency arrangement before they'll really give a definitive answer, you know, because otherwise they'll come back to us with a fairly typical, you know, chestnut response. But you'd really have to give them all the background contracts and information.
It's an alternative, that's
Jonathan,
all it is.
yeah. Jonathan, is that how you see it?
Yeah, absolutely. I mean, I think, you know, we've been to the tax office 3 times now, and we've got the same response each time, which is, you know, here's some general principles to apply. And if you want anything further, you know, you have to give us the detailed facts, and we'll assess it for each particular taxpayer.
Yeah.
Thank you. And Scott?
No, I think that's fine. Thanks, Kim. Look, I think, look, Mariana, Jonathan and Bill have covered that off fairly well. Look, I guess the key thing to take out of it too is that when this was announced, and this is probably more my view, not so much Mann Judd's, it's the Federal Treasurer has announced these, and then everyone has to then run along and do the interpretation side of it. So that's where the challenge has been, not just for our industry, international freight forwarding, but what I understand, other industries as well. So hopefully this has provided some clarity for members across those 2 fronts, the eligibility and or otherwise of them to apply for JobKeeper 2, and then their ongoing BAS definition of revenue. And, you know, we're certainly, IFCBAA is happy to field questions. We would certainly, you know, involve Mann Judd in terms of any assistance that's required, and certainly appreciate the assistance that's been provided by Mann Judd to date on this.